Hello and welcome to another financial analysis video. Today I want to discuss Frontier Communications. This stock has been under significant pressure in the last 52 weeks, but more recently in just the last couple of months, the stock has, first the company has been removed from the S&P 500 due to its market capitalization, and then there have been a series of downgrades and concerns with the stock. And I want to talk today about the stock's dividends specifically and look at a couple of other operating factors. So Frontier, about a year ago, took on a massive amount of new debt in order to grow its business. It primarily deals with hardline communications in rural areas. And as a result of this increased leverage, some of the operating results have turned negative. And this is where I get concerned because I tend not to promote dividends that have negative earnings. But we'll talk about another metric later that speaks more strongly, in my opinion, to the company's dividend sustainability. And that dividend, with the price plummeting, has shot over 10%, now over 20%. The yield right now around 21%, with shares under $2 per share. And I wanted to show this chart just a little bit to describe the leverage that Frontier has taken on with new debt issuance, trying to grow the business. And back to the earnings piece, this is a nice chart that I like to use to show earnings outlook over time. And again, this is speaking to that dividend, whether or not it's sustainable. We originally, in 2015, 2016, analysts felt that the stock would continue to perform with positive earnings. That has since changed, and in the last 2 quarters, it's been expressed that the company will likely return to profitability sometime in 2018. However, when you see these downward revisions, it makes it hard to believe that that may actually occur. So I want to conclude this presentation by talking about one other factor as it pertains to dividend sustainability, and that's free cash flow. The blue line in this chart is free cash flow over a trailing 12-month period. The red line in this chart is the calculated dividend obligation over the next 12 months. About a year ago, Frontier fell below the mark, and they have stayed below the mark that entire time, and they have had some recovery in the fourth quarter, thanks mainly to better performing operating cash flow. However, this free cash flow, while it needs to be used to pay dividends, it also does not include the debt service on some of these the corporate bonds that they have. So there's a lot of pressure here in terms of what they're going to be able to pay and pay back. And so as a result, I believe that the dividend is going to be suspended for Frontier. I think that they don't really have an option in terms of what they're going to do with this. And this free cash flow is going to be used to service their corporate bonds and help to build some capital to pay off some of these bonds as they come due over the next 5 years. I would advise investors to look at Frontier corporate bonds if you want to invest in Frontier, because these high yield bonds do have some attractive returns. And keep in mind that in the case of shareholders who are there for income versus bondholders who are there for income, the company is always going to have to cut the shareholders first before they cut the bondholders. Not being able to make a dividend payment because of free cash flow, you simply suspend the dividend payment. Not being able to make an interest payment on a bond is a totally different, totally more severe situation. So if you want to get into Frontier, I would suggest looking at the bonds versus the stocks. I hope you enjoyed this video. Good luck investing.